Hey everyone, this is Mortgage Mario. I hope you're doing well. So I want to show you a breakdown of what our closing costs for a VA mortgage. We'll just take this by section. So this is just the hypothetical purchase price. And do take note, this is just all for educational purposes. So all these numbers are just fictitious, just so we kind of understand what numbers mean as far as closing costs and hypothetical closing disclosure and loan estimate if you were to go through the process. But purchase price, loan amount, loan to value. So that's the loan amount divided by the value of the home. Um, this is the term as far as in years. This is the term as far as in months. So we just multiply that by 12 and you get 360 months. If you were just to make the minimum monthly payment for the next 30 years, that's how many months there would be to pay that off. Interest rate and APR, and that's really kind of the real cost as far as if you were just to pay off, make your minimum monthly payments for 30 years until it fully amortizes. But essentially, Section A are the costs coming from a lender. So I throw in their lenders can charge origination, so that's kind of like a broker's cost to originate a loan. And then also you have something called discounts, so discount points. You can actually buy down a rate. So good rule of thumb is that, you're about 30 basis points if you want to buy down a rate about an eighth of a percent. And so 100 basis points is about 1%. So this is just totally just depends on a rate sheet and what market volatility is doing on that specific moment of time when a loan officer is looking at rates, but just kind of a very good rule of thumb there. So, in that circumstance, if you wanted to go, if you basically want to remove discount, that rate may bump up, 0.3, 0.4, 0.5%, somewhere around that range, which would bump up your monthly payment, but would lower your closing costs. So about 1 point, which is 1% or 100 basis points of the loan amount, is pretty standard to see as far as buying down an interest rate. But the good thing about points too, they are tax deductible. And the longer you live in the house, the more it makes sense to get points as well. Now that's everything. Section A is basically everything that comes from the lender. So it's good to look at rate, kind of the cost coming from the lender, and APR when kind of comparing lenders as far as trying to go apples to apples. Now, everything else here are kind of third-party closing costs that don't have anything to do with the lender. So essentially, you'll have to get an appraisal on the property. You have a credit report. You have something called the VA funding fee. So some veterans are exempt. So if I'll actually, when I'm conducting a pre-approval, I'll have to look at something called a COE. That's a certificate of eligibility. Some veterans are exempt. I know some veterans, maybe if they have some type of illness or something like that, mental illness, PTSD, or something of that nature, where they are disabled and physically, mentally, in some shape or form, they may be exempt from this. So typically, if it's your first time using a VA loan, the rule on that is when you're putting down less than 5%, it's 2.15% of the original loan amount, which would be 400,000. So in this case, that's 8,600. That gets financed into the final loan amount. And so that doesn't actually come out of pocket on the cash to close. But you could be exempt on that now if you put down 5 to 9.9%, then essentially it'd be 1.5% of 400,000. So that would go down a little bit. And wouldn't make on a purchase price like this, wouldn't make a huge difference on your monthly payment. But it would go down a little bit. And then if you were to put down 10% or more, then it would go down to 1.25. So that's another thing people to be aware of is, obviously it's nice to go zero down, have no cash out of pocket as far as the down payment, but there is the funding fee that gets financed in the loan over time. Inflation and things of that nature will kind of eat that up. And so you're not really coming out of that pocket. So not too big of a deal. Um, some other just kind of nitpicky closing costs that you could see in a final closing disclosure. And then you have a closing attorney that will actually need to conduct title search and need to close on the loan. And so this is kind of the fees that you'll see for them, this is kind of their closing fee. You have something called premium for lender's coverage. So in the event that the closing attorney misses something on title or something's not recorded properly on title, then basically if you were to get the title and someone was in theory maybe in second lien position and the original the seller actually owed them $50,000 that was on the second lien position. Well, now that you have that title, they could come after the lender for that. So we actually have something called premium for lender's coverage. That's government mandated. The lender will be fully covered. It's basically an insurance policy for the lender. And another policy they sell, just to kind of jump over here, is called owner's title policy, which is acts in the exact same fashion, but the same scenario. Title misses something. You close on the property. You have title now. You have ownership, and there actually was a lien on it. A very common thing is like a mechanic's lien. A contractor wasn't paid by the previous owner for maybe some type of work, like putting in sheetrock, for example, and it's $20,000. Well, this is actually an optional thing that we can't require you to buy because it's like an insurance policy. But if you were to buy it and title were to miss something, you would be covered. Title would cover that um, completely. Now, if you waive that and something was missed on title, then you could be basically held accountable for paying that. You would probably have to go through litigation to basically get that to grip. So now, usually in a perfect world, that doesn't happen very often. Title does their job. They do title search, and if there is something on title, they'll catch it before you close on the property. So it's pretty unlikely something's going to get missed on title, but it's always still a possibility. And so there's no guarantees on that, if they'll catch everything on title or not. So um, now these are basically that's the total loan cost to get the loan. Now, a little on VA, a little misleading because you've got about half of that, over half of that, is actually going into the final loan amount. So that 8,600 is going there. So for that funding fee, now you're going to get phenomenal rates going VA, even if you do pay the funding fee into the final loan amount, you get, I mean, way better rates than conventional. Zero down, so less cash out of pocket, and you have no PMI whatsoever. So the VA actually guarantees it. People think that they're getting this money from the VA. VA actually guarantees this 25%. So that's why we're able to waive mortgage insurance because the VA guaranteeing it 25% for the loan in the case that a veteran were to default on their mortgage payments. The lender would be able to recuperate any losses going through the foreclosure process. So next thing here is taxes and government fees. I kind of entered in what it should be in Georgia. Again, if you're in a different state, this is going to change. So again, don't take really any of these fully to heart. They're just more placeholder fees, if anything else. And then you have something called prepaids. So prepaids, basically, you'll have to pay a year up front of homeowners insurance. So let's say we close on this the 14th. You'll actually pay up for a full year of homeowners insurance until June of 2024. So the house will be covered for a year completely. That will be paid at the closing table. So I made up a number there that is obviously we're a fictitious property. We don't know what that is. I kind of just threw in a kind of a median number, something that wouldn't be too crazy to see as far as a annual premium. And then also you have something called prepaid interest. So this can change. So this is a daily interest. So basically, let's say that we close this the middle of June, then you would have about 15 days of prepaid interest because from June to the end of the month, basically you'll be in I call it mortgage limbo. So basically your mortgage you'll start actually having a mortgage on July because your mortgage starts the first of the month. So basically July 1st is when your actual mortgage is going to kick in. So and you always pay a month behind. So you actually won't make your first mortgage payment. If you close in the middle of June, you won't make your first mortgage payment until actually August 1st because you're always paying for a month behind. You're paying for July. Now, what happened from the middle of July to the end of July, where you actually weren't paying any mortgage payments on this property? Well, that's what the prepaid interest is essentially. So if you close in the very end of the month and you have only 1 day left in June, then that prepaid would go down to 1. If you close in the very beginning, well, then it could bump up to 30 days. So that completely depends on the closing date. So again, kind of a just 15, just throwing a number out there, fair number. So you have something called, you're gonna have some property taxes. I entered just county. You could have city property taxes as well. That's gonna depend on the property. So we would look at tax bills. That gets tricky as far as exemptions. You will have something if you're buying this as a primary the beginning of the next year. So in January of 2024, most counties, you'll be able to file for something called homestead exemption, where they'll actually, since it's a primary, you'll be able to get a discount on your property taxes. So we'll be looking at the most recent bill. Typically, underwriters and closing attorneys like to kind of remove exemptions, think worst case scenario, what the highest possible amount for property taxes are, and then think the worst case scenario, thinking that you're not going to file for you'll forget to file for exemption next year. And so if you file, then your taxes could change. And it could lower. They could go up. The tax assessor could assess the value for more. If someone was elderly, then they could have significant exemption as well. So all that is just depending on the county, obviously. So now this is kind of the most confusing thing. You got something called escrow. And essentially, this is most people want to automate their taxes and their insurance. They don't want to have to worry about paying the county when they get a tax bill. So use the county where I grew up in, Cobb County, for example. They collect property taxes are due in October of the end of the year. So basically, depending on when you close on the property, depending on when the county collects property taxes, is going to depend on the amount of months of escrow that the underwriters and the title company are going to want to collect to automate your taxes and insurance with your loan servicer. So this goes into a safe. So basically, the best way to look at escrow is like a savings account with the loan servicer. So essentially, this is not really a cost. This is basically if your property taxes were due in October and you're closing the property in June, well, property taxes haven't been paid yet in 2023. So this money is sitting in a savings account, and you'll even see this when you're paying your mortgage payment that you'll have an escrow account. And basically, instead of you having to pay the county directly, write a check, struggle, or potentially forget about that, put a lien on your property, or you didn't save up, or expenses popped up, you didn't save enough money to pay your taxes, which wouldn't be good. That this is already taken care for you. This is all automated, so they'll dip into that account October, pay that. You won't even really be aware of it. It'll just kind of happen. And the same thing with homeowners insurance. So basically, when homeowners insurance, usually it's going to renew annually. And so basically, it's going to renew in 2024, that they'll have funds in your escrow account to basically pay that, your homeowners insurance. Now, every month, people think that when they're escrowing and they see part of their payments, principal, interest, taxes, and insurance. Okay. So that's the principal and interest, or really, that's really just the amortization schedule on the loan amount. So this is dependent on, obviously, it's going to be a 12th of whatever your homeowner's insurance is. People think that when they're making their monthly payment, especially first-time homeowners, that they're just paying every month. They're paying, say that it's just insurance company, something state, or some company like that, something you're paying something state insurance company. You're not paying that insurance company once a month. You're not doing that. This is going into your escrow account. And then, and really in reality, the loan servicer is going to pay that insurance company basically when it's time to renew the annual premium, which would be in June of 2024. This is going into your escrow account just to make sure that you are saving up money for when that day comes. It's basically to safeguard you from spending all your money when expenses do pop up. Just like if you set up a 401k with your employer where money directly from your check, is going directly to your 401k that you don't even have the opportunity to go spend that on something. So as a first-time home buyer, I always recommend people just escrow because it really just allows you to be fiscally smart and just as and it kind of just acts as a tool to allow you to be disciplined with saving up for these future costs. So now basically whenever you sell the property or you refinance, whatever is left in your escrow account, like in theory, you're gonna have money left in your escrow account because they're gonna make you pad your escrow account with money, then you'll get all that money back. The loan servicer will write you a check. Okay. So we went over owner's title policy. Um, so basically those are all the other costs. And then you've got something called an earnest money deposit. I left that out there because if I put that in there, that's going to be misleading. When you make an offer on a property, you have to have skin in the game. The seller wants to sell, right? They don't want someone to make an offer and back out on it for whatever reason. So basically, you have like a good faith deposit, which is the earnest money deposit. That's typically a realtor will write it up depending on the demand for the property. If there's a ton of offers, they might advise you to put down more earnest money if you really want the property. But typically, in a typical contract, it's 1% of the purchase price. So the earnest money would be 4,000. That gets held by the closing attorney. They hold that basically in the event something happens. So like if you get past all your finance contingencies and the lender were to deny you the loan, the seller could potentially keep that earnest money deposit, just with how the contract reads. If you basically, the VA doesn't have an appraisal contingency, so you're fully protected from a short appraisal and other circumstances unconventional. If you had no appraisal contingency and under appraises and you couldn't come to an agreement as far as on if you didn't want to pay the differential on the appraisal, like say it appraised at 390, the seller still wants 400 and you're unwilling to pay that $10,000 difference, you're past the appraisal contingency, then you could forfeit your earnest money deposit. So you're protected contractually. That's why it's good to work with a realtor that knows the contract, especially VAs, and a lender that will fully underwrite you before you really even go through the official mortgage process when you go under contract. It's very important. That way you know that as far as financing, you're going to be good. You're going to get approved. There's really no worries there. The only thing that could sabotage your own deal is at that point is like if you spent all your money, you financed a car or something like that that made your debt to income ratio go up or something that you did just to basically sabotage your own finances. But if you stay disciplined, and you get fully underwritten beforehand, you really don't have anything to worry about. Then you have something called seller's concessions. Those are just basically in layman's terms, seller paid closing costs. So basically, on VA deals, the seller is allowed to pay all the closing costs. So they could pay all 14,933 dollars here. So now they can pay all closing costs up to two discount points. Remember, one discount point is 100 basis points. One discount point is basically 1% of the loan amount. So, they could pay about $8,000. So you could even pop this up about 1 point and the seller could legally pay that and you could actually buy down your rate. That could all be negotiated by a buying agent. That's why it's very important to work with a local agent that is knowledgeable and it's a very good negotiator because they can negotiate on your behalf to get you the best deal possible. So all that can be negotiated. So I don't do contracts. So remember that a lot of these numbers are going to depend on basically the contract and the subject property that's coming my way. So all this is destined to change, but that could in theory be paid completely by the seller and you actually could in theory get into a house zero out of pocket, nothing out of pocket, which is phenomenal. So I left this out, but basically there'll be like a little bit of accounting equation. So let's just think of like a county that I'm from is Cobb. Property taxes are due in October for 2023. So um, property taxes haven't been paid yet, obviously, since they're not due yet till the end of the year. And basically, when you move this property, when October comes out, you're gonna pay for a full year of property taxes. That's just how it works with the county. You'll pay 1 year to them. We'll say that I estimated at $4,000. You're gonna pay $4,000. Well, think about it. Is that fair? You weren't living in the property for almost 6 months, about 5.5 months. The seller was living there. So basically, in this circumstance, if you close in the middle of June, that's about 5.5 months. A seller lived there for 2023. What title will do in the final closing disclosure is they'll basically do the math on that after they conduct title search, and they'll take 5.5 months and they'll multiply that by whatever they calculate for property taxes. Remember, on a loan estimate, which is your good faith estimate when you go under contract, it's the first estimate you get. Property taxes aren't guaranteed to be right. We'll look at a previous form, but closing attorney may honor exemptions, may not. There's some factors that are out of our control. We'll put in a very, very close estimate, but so basically they'll take that, multiply by 5.5, and the seller will give you money for that proration of taxes at the closing table. So, that can go down, about $600 or something like that, basically is what that will come out to, which will lower your cash at close, which again, that's not really the seller giving you money. That's really just to make the equation work. Same thing if you had city property taxes. I just left that out. And then that's where you're seeing the total cash at close. So one thing I've dealt with veterans is the education part where they think, hey, it's zero down. I don't need any money. I'm good. I haven't saved up any money, Mario. We're good. We're gonna go on the house hunt. And I go through the pre-approval process, and maybe a veteran has saved up, $2,000 or $3,000 in savings. And then I go over this, and they always get shell shocked, no pun intended. and and I start going over the numbers, and then and then people obviously want an exact on the penny number, and then you can kind of tell how I'm going through all these third party fees were in situations that can basically, depending on how a contract is negotiated between a seller and a buyer, can affect the outcome, and even the subject property is going to affect the outcome, closing dates, other third party fees, obviously real estate professionals, and then you know that's where it can be challenging, where you want to be conservative. You want to make sure that you have enough money saved up, and I always recommend enough money saved up, assuming the seller won't pay closing costs, and maybe even a couple mortgage payments as well would be kind of the fiscally smart thing to do. And then it's just a cherry on top when you could get $10,000 paid by the seller, which is very possible to bring that down to $4,000 or $5,000. So, um, but yeah, this really basically encapsulates all possible closing costs that you could pay. If you have any questions, feel free to contact me at mortgagemario.com. And remember that we are a veteran-owned company too. So, if you're a veteran, support local small business veteran-owned companies. Take care.